8:45. Now, we hear almost every day in the news that artificial intelligence is the wave of the future. It will change all kinds of aspects of life, including how you invest or others invest for you. And here to talk about the effects on the financial sector is Gerrod Galliano, a financial advisor with Burns Estate Planning. Good morning.
Yeah, good morning, John.
So what's your take on AI?
Well, look, it's one of these things that a lot of people hear about in the news. They think, what's this going to do to my portfolio? How's this going to help make me affect decisions that we make? But one thing people need to realize is about 2 or 3 years ago, for the first time ever, the market saw more computer trades than people actually making trades. And that shifted from about 50% to recently almost 60 to 80%.
So what's the effect of that then?
Well, the effect of that is increased volatility. So imagine it like a cascading effect. You have one algorithm that's in place that says, if this happens, trade. Then another one gets affected, and another one. So you have these cascading effects, negative and positive, on the market.
And we've seen a couple of times the market might really tank on a day, on an afternoon, not necessarily to the point that it's a bust or anything, but a real serious drop. And then you'll hear some analysts say, well, that's because some computer algorithm did such and such. And
absolutely.
Does it need to be more regulated?
Well, some people do call for regulation. I think ChatGPT founder was just in Washington yesterday, for instance. But one thing about the market is some people think, purists, that the market does correct itself with these trades over time.
I guess you would say there is a difference between a computer algorithm doing what you're describing and true AI, which would be theoretically reasoning and talking through complicated steps and then making trades. Are we ever going to see that?
We don't think so. While people use the algorithms as tools, and they use them quite a bit, and we're talking about day traders, hedge fund managers, more so than firms like ourselves who are long-term investors for retirees. We want less volatility, not more. However, we do think that while the AI is intriguing to many, you have to have someone responsible at the end of the day who's going to answer to those trades.
Do you see it as a tool that you could theoretically use sometime in the future where a bot or an artificial intelligence software spits out a result and then you look at it as a professional and say, oh,
yeah, absolutely.
No, I don't agree, or oh, that's a great idea.
Any data is interesting. One thing we don't want to do is keep our heads in the sand and play like it's not out there. We want to know how it works, and we want to know the pros and cons, but ultimately we want a person at the end of the line making that decision.
You'll hear about big companies that sometimes their stock price is way crazy compared to their earnings. But ultimately, at some point, your stock is based on how much money you're expected to make in the future. A bot can't create, an AI program can't create wealth. In the long term, if you're a long-term investor, what would you advise?
Oh, we advise this. Long-term investors, time in the market, more important than trying to time the market. And all that software is trying to do is time the market. If you're super young and you're interested in some of the day trading stuff, maybe it's for you. But long-term, we say, stay away from it. Make sure you have a strategy and a plan going forward. And in times of high volatility, if you're retired, you don't want to be utilizing this because you're going to just see lots of fluctuations.
This is another sign of how this stuff is potentially going to take over. Gerrod Galliano from Burns Wealth, thanks.
Thanks for having me.